Hey, it's Jim, and this is Level 1 of the CFA program, topic on financial statement analysis, and the learning module on the analysis of income taxes. I'm guessing you can tell by the sound of my voice that I'm under the weather. Of course, it's the result of hanging around my grandchildren who are coughing all over me. But I tell you, a hug from my little granddaughter is worth any kind of a cold that I can get. My point is, I'm feeling about 65 percentile of my perfect health. But yet here I am, full of energy, ready to try to make analysis of income taxes exciting to you. So if I don't do it, we'll just blame it on my 65%. My extra point is that, hey, you guys are not going to feel like studying. Of course, during the until the exam time comes around. When you feel like not studying, remember me. It's the fourth quarter. I'm in here. I'm playing hard, even though I'm not feeling perfect. Now, the good news for you guys is that although this is not too terribly long a learning module, there are only 8 questions at the end of this learning module. And the majority of those questions are for Learning Outcome Statement 2 and 3. Now, of course, they're based on the definitions in that first LOS. So we'll cover those relatively quickly, and then we'll focus on second and third. And then we have a couple slides on disclosures. But you've heard me say this before multiple times that, when in doubt, go ahead and disclose. Some of the things that we need disclosure here with the difference between a temporary and a permanent difference between stuff that goes on the asset side, stuff that goes on the liability side. And you'll see what I mean here in just a second. So I'm guessing you probably know this from maybe your undergraduate accounting days, accounting profit, and this is just reported on the income statement following the accounting standards, whether they're the international standards or the U.S. GAAP standards. Has a couple of other names for it. Does not include a provision for income tax expense. We talk about income tax expense and its absence in accounting profit somewhere else in other learning modules. I hope you remember those other instances. Taxable income, on the other hand, is, of course, the income that's subject to income taxes. And that's, of course, based on the laws and rules and regulations of individual countries. Now, here's some really good definitions. Looks to me like this is going to show up on the exam. The carrying amount is the value of an asset or a liability on the financial statements. So we've looked at Nike statements. You guys can easily type in Milton Hershey or Procter & Gamble, and you can get from Yahoo Finance all these financial statements. So that's the carrying amount. The tax base, on the other hand, is the value for income tax purposes. Now, you might be thinking, here, let me go back here real quick. You might be thinking that, especially those of you who are novices in the accounting field, you might be thinking, you know what, why are these things not the same? And I share your sentiment. I'm like, let's try to make life easy. But there are different rules and there are different laws and there are different ways of handling assets and liabilities. So sometimes, in fact, many times, we're going to have a difference between these two. And these differences, they can be temporary if they are going to be like a naturally recurring offset at some time in the future. But a lot of times the differences become permanent. And we'll talk about that here in just a little bit. But some examples of how the difference in between these two arises. Timing differences. This is probably the most obvious example. And in a little bit, I'll show you an example in which we depreciate an asset over 10 years for one set of statements, and we depreciate it over 7 years for another set of statements, and that difference in timing between 10 and 7 causes the difference between these two. And we have some math that I'll show you. Sometimes revenues and expenses, remember we had that whole thing about when do we recognize revenue, when do we incur an expense? Well, sometimes we can do it for one financial statement and we don't do it for another financial statement for a variety of reasons. Many of those reasons are embedded in the laws of that particular country. Sometimes you can deduct something on one statement and you can't deduct it on another. And this is one of my interesting things that I always scratch my head, that if you have a loss, you can carry it forward, you can carry it backward. I guess you can carry it sideways if that would be possible, but that doesn't sound like something that we would want to do. And so it's really just saying something like, you know what, if you stink this year, you can go back and adjust your taxes for previous years, or you can carry it forward. So that carry forward is going to create a difference between the tax base and the carrying amount. So this is probably a good question here on the exam to tell me what are the sources of the difference. Now here's just a quick slide about the difference between tax base and carrying amount. Some of these differences can be temporary, some of them can be permanent, and we'll see that the permanent changes are not too terribly common. All right, let's talk about these temporary differences. Yeah, occurs when the carrying amount exceeds its tax base, or the tax base of a liability exceeds its carrying amount. I'm going to show you a table here in just a second. I want you to take a picture of it. So what happens here is that we're going to recognize a deferred tax liability. There's the example we'll see in just a minute. Accelerated depreciation for tax purposes, but then some other kind of depreciation method on the financial statements. And so that's going to create a temporary difference. And you'll see that here in just a second. What happens then over time is that we get a tax break today, which means in the future, we're going to have an extra tax liability. We have to make up that difference. Now, the cool thing, and you guys should know this, of course, is that even though we may have to pay more taxes in the future, what we do is we get the benefit of the difference in time value of money of the lower tax liability today versus 2 years or 5 years or 10 years or whenever that is. Look down at the bottom there. I can't imagine the Institute would ask you a question, but this is something that might find itself in the back of your brain. You know, these temporary differences, they exist inside of the same tax authority and the same entity. So don't be fooled if the Institute says something like, hey, here's a company operating in Canada, also has a subsidiary over here, has a subsidiary over there, and then they try to trick you about what are these temporary differences. Remember, it's got to be inside of that geographic boundary. And then this is what I was saying earlier, the expected reversal must occur in the relatively near future, whatever that means. Here's this table I wanted you to take a picture. So get your phone out, take a picture of this. This shows up at the end of the learning module as a question. So on the left-hand column, we need to worry about assets or liabilities. So if the carrying amount is greater than the tax base, depending on whether it's an asset or a liability, we're going to create a deferred tax liability in the case of the assets, or a deferred tax asset in the case of liability. So have a picture of this. This will be super easy to memorize, but I guarantee you this will help you on the exam at some point or another. So let's go ahead and work through just a quick example before we get to our depreciation example. Here we have a carrying amount, there's the second column, and a tax base in the third column. And we have some accounts over on the left-hand column. Notice that some of them are identical and some of them are different. So look at that temporary difference. We just have some zeros and we have a couple of numbers there. So let's go ahead and list what is created, whether it's a deferred tax asset or a deferred tax liability. So let's just go back here. You have this picture in your brain of this table. So the fact that any kind of a loan and interest paid, those are all the same, so there's no difference. So we don't have to worry about a deferred tax asset or a deferred tax liability. However, developmental costs, we have the carrying amount is greater than the tax base, right? $2,750 over $2,500. That difference is $250,000. So this is a deferred tax liability. For research costs and for rent received in advance, you can't recognize that for. So you shouldn't be surprised that there's a zero there. So those are deferred tax assets. And then for dividends receivable, they're the same number. So you don't have to worry about that. How about a permanent difference? There's some examples there, income or expense items that are not allowed by tax legislation. So those are permanent, meaning that they're never going to come back. If they're never going to come back, look at that second bullet point. No deferred tax is created if you know the difference is permanent right away. And that's important. The interest on tax-free municipal bonds. This is mentioned in many, many things. In fact, I even remember this from from my CFA days that that tax-free municipal bonds, we don't have to worry about that because that's going to be a permanent difference. Some other examples are things like fines. If a company gets fined for polluting, I think that judgments against it in a legal sense, I think those are permanent as well. Now look down at the bottom. These permanent differences there, they're going to cause, some kind of variability between the effective tax rate and the statutory corporate tax rate. Now, if you don't know the difference between those two immediately, hold off. We'll go ahead and get to that here in just a little bit. I'll go ahead and warn you that there are, four or five of those questions at the end of the learning module are on those different types of tax rates. We'll do that in a little bit. Here's a summary of that earlier table and a summary of that little example that we just did. So if the accounting income is greater than taxable income, then we have future taxable amounts. So this is a deferred tax liability, meaning that we know that at some point in the future, we're going to have to make up. We're going to have to we got a benefit today, but we're going to have to make it up at some time in the future. And then in purple over there, if just the opposite happens, we know that we're going to get a reduction in a tax liability at some time in the future. Yeah, so temporary differences will reverse out. Maybe this year, maybe next year, maybe in 2 years or 5 years. But if it's going to be like 100 years, then that sounds permanent to me. Now, what happens over time if we create this deferred tax asset or deferred tax liability is that we need to check on it and see how it's doing. And see, okay, we thought that the tax base was this number, we thought the carrying amount was this number, and so we created this deferred tax asset or deferred tax liability. And then after some time, did those differences materialize? Did they continue, or was there some change? Maybe one grows at 10%, maybe one grows at 4%. And I have an example here in just a little bit. Look down at the bottom. This is one of those great exam questions where the Institute could just give you a comment or a concluding statement or a remark. Lower tax rate reduce the value of deferred tax assets. Lower tax rates also reduce the value of deferred tax liabilities. So just remember those definitions. That might show up on the exam. We've looked at Nike's financial statements in other learning modules and slide decks, so you can see a whole bunch of stuff. So they have deferred income taxes and other assets, 2732. Over on the right-hand side, deferred income taxes and other liabilities. So note that Nike, they have some of the assets and some of the liabilities, and this is not uncommon. I'm guessing that the Institute would probably pick one or the other and not have you combine them. If the Institute does ask you to combine them, you might be tempted to just, 2732 and 1687. You might just be tempted to take the difference between those two. That's probably not a bad answer. All right, a couple of things about Nike's annual report. Those deferred tax assets can only be created if a future economic benefit is expected. What if there is doubt about those future benefits? Well, then that deferred tax asset should not be recognized. And there are some differences, just minor differences between international standards and the U.S. standards. All right, let's work through this example here where we have year 1, 2, and 3. Notice we go backward from year 1, 2, 3. So orange, purple, and red. Here's Galaxy Manufacturing, and so we've got revenues going from 30 to 40 to 50, and then these accounts go all the way down. There's that profit before tax, and there's some interest expense. So the question then becomes, here are the questions here, but some other assumptions. Assume that all income and expenses are treated identically for both, except for depreciation. So this is what I was telling you earlier. We're going to have everything constant except depreciation. So look at this, $25,000 for the equipment, but we're going to depreciate it under 10 years, and then we're going to depreciate it under 7 years. So the difference between 7 and 10 is going to create a temporary difference here. Salvage value is 0. I remember being an undergrad. I just remember hating when a professor would give us a salvage value, because I always said, how do you have any idea what this thing is going to be worth in 5 years or 8 years? But, you got to do whatever the accounting professor says. Tax rate of 30%. So let's calculate 4 things here: taxable income, carrying amount and tax base, accounting profit and taxable income, and then income tax expense. So you might want to pause the video a couple times here just to make sure that you're following along the math. I'll try to keep you up to date. Here is the replica of the financial statement from a few slides ago with that depreciation expense in there. And this is going to be for taxable income. All right, remember back here, where was that? 10-year depreciation. So if we take that $25,000 and we divide by 10, we get the $2,500 worth of depreciation expense. But if we take that $2,500, look down on the bottom right there, if we take that $2,500 and divide by 7, we get $3,571. So what's going to happen is that there's going to be this creation of some kind of deferment, because we are taking depreciation expense on one financial statement that's more than depreciation expense on another financial statement. So this is going to be reflective somewhere down at the bottom on income tax expense. All right, let's get into the weeds just a little bit here. So up at the top, there's our $2,500 worth of depreciation. Now down at the bottom, there's our $3,571 of depreciation. So look at this. Let's start over in year 1. We have profit before tax of $6,400, which is greater than $5,329. Think about that difference there. Then we go to year 2, $22,500 and $21,429. Then year 3, $35,100, $34,029. So those are the differences there, and let's examine them in even greater detail to see exactly what the impact is. So notice we're going year 1 on the right, and we're working our way to the left. All right, so we're doing the carrying amount in the first row, and we're doing the tax base in the second row. So let's start with the 2,500 and 25,000. Subtract out the 2,500, we get 22,500. Makes sense? So then let's just do the same thing in year 2, same thing in year 3. You might want to just pause the video quickly just so you can verify that those answers are correct. But then what happens? Down here for the tax base, we're taking 25,000 minus the 3,571 and getting 2,149, and then we're doing it again, and then we're doing it again. So the difference starts out in year 1 of 1071. Excuse me. In year 2, 2,142, and in year 3, 3,214. So this should be percolating in your brain that the difference between the carrying amount and the tax base is a function of the 2 different depreciation time periods, 10 versus 7. So let's go ahead and figure out exactly what that deferred tax liability is going to be. Now the top part there, that's just a repeat of what we had on the previous slide. So let's go back over here to year 1, and let's take the difference between the 22,500 and the 21,449, right? Just subtracting a carrying amount minus the tax base, and we get, well, whatever that was. That's the 1071. Multiply that by the 30% tax rate. I think we were given 30% back there somewhere. You guys want to verify that? Where was that? Somewhere in there. Yeah, down at the bottom. So you take 30% of that and you get 321. And then, boy, do you want to just kind of add 321 to that? I mean, you could, and you're still going to get, what is that? Well, 643 from rounding. So take the 20,000 minus the 17,858, multiply that by 30%, you get the 643, and then once again, you get the 964. So, look at that LOS. It says, determine how a company's deferred tax liabilities should be treated. we're determining it here. I would be prepared to go ahead and make those calculations of 321, 643, or 964. At a minimum, if you calculate those numbers, you'll be able to answer questions that say, explain this and determine. I think those are good. Let's move to that fourth question, determine the income tax expense for each year. Remember, this is going to be a temporary difference, and let's work from year 1 all the way over to year 3. So the top there, as I said, that's just a repeat. So how do we get that income tax payable? So let's go back here, and let's do this. You guys want to get your calculators out? I got mine. Remember, I can't see. So what is that down at the bottom? 5329. So let's do 5329. And multiply that by 30%. So if we come down here, that ought to be whatever that number is. Yeah, 15. I got 1598.70. Yeah, so there's the 1599. And then there's that change in deferred tax liability from 0 to 321. And if you sum those, you get the 1920. So what I want you to do, just to kind of see exactly what's going on, go back here and put 6,400 in your calculator and multiply that by 3%. And what do you get? You get voila, as my mother used to say, you get the 1920. So you get the sense here that what we're doing, we've got, we have one set of financial statements at the top, one set at the bottom, one for financial reporting, one for income tax reporting. The only difference is depreciation expense. So we ought to be able to identify what that difference is. And that difference is, well, look along the bottom here, the 321, 643, and the 964. And then that difference each year, that's going to be the same number, right? So 321 and then, 322 just for rounding. And so you get 1920, 6751, and 1053. Feel free if you want to pause the video and go ahead and make sure you can compute the income tax expense at the bottom of year 2 and 3. Yeah, so what do we have at the bottom there? Income tax expense. There's the taxes payable plus the change in the deferred tax liabilities, which is what we did back here. And I did say this earlier, if there is a change in deferred tax assets, then make sure you subtract it. So there's a plus sign and then a minus sign. Putting this all together, if we want to, whoops, sorry about that. If we want to put this all together, we can just work our way down. There's our depreciation expense. Then there's our interest expense. And then you go all the way down to profit after tax from 4480 up to 24570. All right, how about this third one? I said this was important. There's 4 or 5 questions on each of these rates. So look, calculate, interpret, and contrast. So here are the definitions. Statutory tax rate. In fact, I was just talking about this in my corporate finance class today. Yes, I taught today, even though I wasn't feeling 100%. I wonder what my percentile would have to be where I wouldn't go into school. I hardly ever miss class. Anyway, I asked my students. I said, "Hey, does anybody know what the U.S. corporate tax rate is?" And there's some good business students who say, "Yeah, I think Trump changed it to 21%. And then I go ahead and ask them, I was like, what should it be? And I remind them of double taxation. I'm like, it should be 0%. I mean, you have to make it up somewhere else, but double taxation doesn't sound like anything that I want to be a part of. But nevertheless, that's what we have. The effective tax rate and the cash tax rate, sometimes they're going to be the same number, but sometimes they're not, depending on exactly when those taxes are actually paid with cash. So effective tax rate, you should know that equation, right? Reported income tax expense by pre-tax income. The effective tax rate reflects the actual tax burden of the company. Now, you should ask yourself the question, why doesn't every company in the United States pay that 21%? And there are a bunch of different reasons, and here are a couple of them. Some dividends, non-deductible expenses, some tax credits. Effective tax rate, this is a good question, that second teardrop point, that is consistently lower, warrants attention. Notice we put this in bold, so I'm guessing the Institute has emphasized this inside of the learning module because this is a great exam question. Makes sense. Focus on one-time events, worry about volatility, excluding special items. Yeah, that makes perfect sense. So let's go ahead and work through an example because you have to know this stuff. So here's a company operates in country C and E, and here are some tax rates. So they make 250 in each country. You see that purple and blue. Total is 500. Tax rate in one country 15%. Tax rate in another country 35%. So go ahead and multiply that out. You get whatever those numbers are, and then you get 212 and 162. So here's the deal. On the next slide, what we're going to do is we're going to say, hey, suppose it's still 250 and 250, but suppose that country C sees its earnings before tax increase by 10%. So there we go. Look at country E. Look at the, what is that, third or fourth row. There's 250, 250, and 250. Country C goes up by 10%. So you have 250 to 275, et cetera, et cetera. So then what happens? Then we've got this total earnings before taxes, 525, 552, 585. There's the effective tax rates, 15% in country C, 35% in country E. There's the total tax. So the question is, how do we compute the total effective tax rate? And you guys are going to love this here. So look down at the bottom. It is simply a weighted average. Now in the first year, it's 250 and 250, so it's just 1/2, right? Times 15 and 30, that gets us 25. But then what do? We have different numbers. So 275 over 525, 250 over 525. Now we've got 24.5, and then we've got 24. So there's a gradual decline since a higher proportion. And this goes back to our conversation of weighted average cost of capital. The underlying math is still the same. All right, I warned you at the very beginning that I wouldn't have too many cool things to say about disclosures, so I'm not going to let you down. I don't really have any cool things to say. But what do we need to know? We need to know which financial statement, which statement are we looking at? Is it the tax thing, or is it the financial reporting thing? And we look at the disclosures to explain all the stuff that we just went through over the last, 25 or 30 minutes. We've seen these highlights for disclosures: provide detailed information, indicate if any valuation allowance has changed, identify loss carryforwards, unused tax credits, all sorts of stuff like that. Now, this one final comment I will make is that, and I said this earlier in the slide deck, that, hey, let's wonder if, here we are in the United States, corporate tax rate is 21%. Depending on who holds the White House and controls the Congress, that thing might go up to 24% or 28%. It might go down to 15%. So what happens here? So I would know these bullet points. And that takes us through these LOSs. So this was not the most exciting kind of a conversation. I'm guessing I offended some of you who have great backgrounds in income tax preparation. I didn't mean to do that. Anyway, only 8 questions at the end of this learning module. I bet you could do these in 5 minutes or less. Not too much math, and definitional in nature. So thanks for watching. And what did I say last time? Do you guys remember I signed off a different way? I'll see you when I see you. Hey, good luck studying.